Anand, good morning and thank you for joining us. Always a pleasure connecting with you. What's your understanding of the way how markets have moved? You think the market reaction in the month of March and early April is justified, or markets have reacted way, or the price damage is way more than what the actual fundamentals they warrant?
Good morning. Thanks for having me on this call. Markets are grappling with multiple uncertainties at this time. First is the uncertainty regarding the pandemic, whether the world will be successful in controlling the spread and also eradicating the virus eventually. So there is a whether question, and also there's a when question on how long it is going to take for us to get to that situation. And both the questions remained either partially or fully unanswered, in the sense that while a significant progress is being made across multiple countries and cities through various measures like lockdown, aggressive testing, quarantining, etc., we are yet to see a meaningful flattening of the curve, or what you call the day-on-day changes moderating. Of course, it is moderating in select countries, select cities as we speak, but market is reacting to those data on a very, very volatile as well as significant manner, so that we need to recognize. So if you get more positive data, then we should react a little more positively. It's quite obvious. The second is when would we eventually see the normalization of the situation? I think that is where I think the market is still extremely uncertain. There are estimates starting with 2 quarters to 2 years, etc. The economic impact of the pandemic. I think if you go by our last experience regarding global growth shock, which is a global financial crisis, we saw multiple quarters of negative growth in many developed countries, though the emerging countries did not have significant economic shock. However, in the current case, we would note such differentiation. Both developed as well as developing economies will have economic shock. And while it lasted for 5 to 6 quarters in GFC time, one hopes that it is of similar magnitude, and not more, in the current circumstance. So in terms of timeline, probably we are looking at 4 to 6 quarters at least for economic situation to normalize.
Okay. If that is the case, how does one figure out that markets are already pricing in a complete washout of FY21? Since you refer to GFC crisis, unfortunately, the data for GFC crisis was that benchmark indices globally and locally, they fell more than 50%, they bottomed out. Right now, we are down 30%. So if this is a crisis which is bigger than GFC crisis, then the downside just about has started and the nightmare is not over.
It's very tough to pinpoint when and where exactly the bottom will happen. It can be 30%, it can be 40%, 50%. It all depends on... just to kind of differentiate between GFC and the current situation, is GFC was a financial market crisis, which later on spread to the economic crisis, whereas in the current situation, we have a healthcare crisis, which is impacting the economy first, and therefore derivatively it is impacting the financial markets. So there's a nuance there. But so in GFC crisis, financial markets got impacted most because it was a crisis originating in the financial markets, whereas here we would see a slightly different reaction. But having said that, yes, there is a danger of calling the bottom too soon. Again, if you look at the timeline of GFC, while it started in February 2008 and markets bottomed out in March 2009, economies continued to report very feeble growth for 5 to 6 quarters. And it took more than 4 to 5 years for market to cross back the previous peak, whether it is in US we are talking about or in India. So some of these impacts can last longer than we can fathom or hypothesize at this moment. So we need to be careful on calling out bottom too early. And that is my own learning, just looking at the previous experience of GFC.
Okay. So, how should one now, how should now one plan about projected returns and asset allocation? Because, like you said, that one should not be in a hurry to call a bottom. Then one should not also be in a hurry to assume that after the crisis, the new cycle will start automatically. So, are you making a case that the pain in price is difficult to call, but the recovery in terms of percentage for next 6 to 12 months, 12 to 18 months may not be large? We are not in for a V-shaped rally or recovery for stock prices?
Yeah, there is a thought process that we will seamlessly move from one bull market to the another bull market with a very limited period of correction, etc. We don't have historic data point to suggest such smooth recovery kind of a thing. Recoveries are painful. Recoveries take time. Recoveries take significant readjustment and recalibration of economies and companies. And some of the companies will get irrevocably harmed or injured in this process. We also know by the past experience that leaderships change, sectors rotate in such a situation, and therefore we cannot simply continue from where we left the last bull market and then extrapolate from there. So that is my one point. Second is market recovery need not have to be post the earnings or economic recovery. Sometimes market will recover ahead of the actual earnings recovery or economic recovery. As if the markets get confidence that we are getting out of problem, then it's quite likely that stock prices will normalize. Stock prices will normalize not necessarily based on future earnings alone. They normalize based on past earnings. They normalize based on book values or replacement cost, etc. There are multiple valuation parameters which may be at work before earnings growth kicks in. So a certain amount of normalization of the market is not contingent upon growth recovery, though I think subsequent growth recovery will be a fodder to subsequent improvement in stock valuations. But suffice to say that thanks to the correction, stocks look sufficiently cheap with respect to their historic earnings or asset value or replacement value.
You have a large exposure to private banks. How do you think markets are likely to reposition within the private banks? Do you worry that given that we have a cash flow problem and some corporates after the moratorium period is over, both corporate and retail, will struggle to pay up their installments and EMIs, do you think that in FY21 or somewhere in FY22 we could be staring at a new beginning of an NPA cycle because demand is not there, cash flows are not there, and once the moratorium of 3 months is over, do you think a lot of problems will surface up which markets need to be a bit wary of?
Okay. The general framework we use in the banks is to some extent banks are the lagged indicators of economic realities. When things are going good, again, banks have a long tailwind of good growth. When things go bad, it impacts the banks with a delay, but it kind of has a long tailwind, long headwind of that impact as well. We have seen it in the last NPA cycle. Despite the economy kind of recovering well, many banks continue to struggle with delinquencies and bad loans. And just now we have gotten through that big cycle. So in that sense, I would say banks would, the problems that come up in the economic system will show up with the lag in the banking system that we should recognize. Second is, yes, the current situation will put undue pressure on both SMEs, MSMEs, and retail loans. Wherever there has been an impact in the business, impact in the earnings of those borrowers, we would see the stress developing in the bank books. Whether you are a retail bank or a microfinance bank or a MSME bank, or even big corporate banks, we might see some eminence of stress. And that would, therefore, one need to be careful in their exposure to banks. Yes, we do have reasonably meaningful private sector bank exposures, but even within the private sector bank, We have seen in the recent past there are multiple incidences of stress, multiple instances of the pain that is getting transmitted, and meaningful erosion in the equity values. So when there is a big economic headwind, whether it is a public bank or a private bank, I would say there will be consequences, and I think we are extremely aware of it. While some of these banks are extremely well managed banks or well capitalized, have very good risk systems, and extremely competent people managing them, and we remain from a bottom-up basis confident on many of these investments. We also recognize that they will have to traverse through these turbulent times and come out on the other side.
Anand, it's historically seen that when the market cycle changes, the leadership of the market also changes. You know, when TMT bubble got pricked, infra stocks made a comeback. When infra stocks got a hit, consumer stocks made a comeback. Where do you think this change in market disruption will lead us? Do you think good old private banks and consumer names will still dominate market share, or now markets will migrate to, let's say, pharma, PSUs, high dividend yielding stocks? What is your sense?
A good thumb rule to start with is which sectors are going to get least impacted during this down cycle or economic sluggish period. Clearly, staples, which are required for day-to-day consumption, will relatively get less impacted, though some of the stocks are richly valued. Some have meaningfully corrected as well, so one can be constructive towards that. There are also sectors which are extremely important in these junctures and which don't require leverage, people to borrow money, to spend, etc. These are definitely healthcare companies and even telecom, I would add to that, where these are essentials in some sense, and one need not have to borrow loans to consume these products. And therefore, I would say there are enough ideas to be picked up from healthcare and telecom, and even to some extent IT. The classic defensives are the ones which would remain defensive, in my own understanding. That is one way to kind of approach the market. The other way is what are the things that are likely to come back when things normalize. Even within the discretionary consumption space, is it going to be the retail stocks, or it is going to be auto, or it is going to be cement, etc. So there, I would put a pecking order would be that the ones which involve less borrowings and therefore easy to kind of normalize, are the ones which will recover in terms of discretionary spending. So some of the retail names which involve not high ticket purchases would tend to recover. Automobiles will be the next, especially the lower valued two-wheelers and maybe the small cars, etc. And then probably homes and construction and cement, etc. So they are going to be a little back-ended because this would involve new, fresh, big outlays. Yes, to the extent that people are going to complete the existing constructions, there is going to be demand coming back, but I would rather wait and watch for demand factors to improve at that juncture. So these are the two kinds of framework I will use at this juncture. I will not try to call out what are the big leaders that are going to be in the next cycle. In the last cycle, we had financials, we had some bit of new age tech, etc. It's not very clear at this juncture as to what's going to lead the rally, but I would like to look for a framework which involves first ones which are less impacted, and second is what will come back at the earliest point of time.
Okay, a word on the government action. Now, some would argue that all other governments globally have done a huge stimulus. we've not heard anything which could be called as disproportionately high from the Indian government so far. First, they've done what is need of the hour, which is transfer money via the direct benefit transfer route to the poorest of the poor. And Reserve Bank of India on expected lines has cut rates and has given a moratorium. But we've not got what could be called as a big bang package for the industry or the affected sectors. Are markets disappointed on that front because of it, because nothing has come out so far?
You're right. The government has done a fairly good job of providing some safety net to the poor in terms of income support or food, provision of foods and ration, etc. So there's been some kind of protection for the poor. I think that is where significant efforts of the government has gone in the initial weeks of the COVID breakout. I think some of the measures which RBI and government announced economically are to kind of protect or to kind of avoid the tail event of big negative breaking out. These are not necessarily an aggregate demand boosting measures or employment generating measures. We are yet to see meaningful effort from the government on growth stimulation and employment generation activities, maybe post the lockdown period or towards the later part of the lockdown period. We may see that. Market is expecting something on that. It does require help of the government, stimulus to kind of come out of the growth shock. We have entered that growth air pocket, and we are going to have trouble to come out on our own without a stimulus package. Stimulus can be in multiple sectors. It can be in automobile sector through scrappage policy. It can be for housing sector through higher tax benefits. And it can be through to any other sector through some kind of income tax deductions, income tax rate cuts, etc. Government it's got a lot of powerful tools to stimulate the economy, and we have to acknowledge that. And hopefully they will come up with a slew of such measures to get the economy back in shape. But as things stand today, we have not yet seen anything of that magnitude.
And then the way I look at things is that the medical crisis, sooner than later, all of us are praying will get over. But post that, where do you think so much of liquidity will move? With 0% interest rates now in US, and with everybody hungry and desperate for growth, where will flows move now?
So globally, the rates have taken a nosedive clearly, and people are benefiting out of the fall in rates. But domestically, we have seen a massive stickiness of rates. Borrowers continue to borrow at high interest rates, despite extremely low inflation, low growth, etc. So I think we are running super high real rates, and that needs to moderate. So if global liquidity can be harnessed, and we also may take some bit of policy measures to ensure that the borrowing costs come down. Of course, it will put some pressure on the savers, but at this juncture, it is the cost of borrowing which is significantly high and disconnected with the economic reality, and therefore, and it will provide much needed, I would say, the cushion for any kind of economic stress. And I think that is where the liquidity should be focused towards. If it goes to market without really leading to a drop in the cost of capital, then we will look at another kind of a bubble kind of a situation, which we should avoid. So the policy measure should be directed towards harnessing the global liquidity as well as domestic liquidity to bring down meaningfully the cost of borrowing.
Anand, we both know that ultimately for equity investors, there are 2 or 3 variable factors which we need to look at. Entry point, which is valuations, projected earnings, and the underlying cost of inflation and cost of borrowing. So if you have to connect everything and weave into a thread based on the current entry point, inflation, cost of borrowing, what do you think equity as an asset class for next 2 to 3 years proposes, because equity always is a function of your cost of borrowing. Cost of borrowing is so low, I really don't know how can one calculate the terminal rates now.
Yeah, that may be a mathematical problem, but I would keep it for a second outside this framework you are suggesting. Now, are we at the right cost of capital commensurate with our current growth and inflation? That is, my understanding is clear. No, we still have a meaningful way to go there. But having said that, are we also at the right valuations for us to say that the entry points are fantastic? Is that I will not be able to say it with high conviction that we are at the bottom or trough valuations per se, but we are getting there. And therefore, I would not like to be fussy too much about where the bottom lies. So maybe you will get one out of the 3-4 of the by variables the equation correct. A lot depends on the time period to normalization. While entry points may be right, how long it takes for us to normalize also will determine what is your holding period return. If you normalize quickly, you will make a high holding period return. And if you normalize gradually, you will make more moderate holding period return. So the mental model that we are all running unfortunately differs from one person to another person. That's the beauty of the markets. Would determine what the expected return we are going to make. My own guess is that even if growth comes back to the pre-COVID growth rates, and even if valuations don't get back to that kind of levels, and there is a earnings recovery beyond 2021, fiscal 21, we would see returns that may beat the fixed income returns comfortably. And that may be a good starting point for making incremental decisions. Of course, we have to recognize that people have made meaningful losses by investing in equities over the last few years, and therefore it will be very insensitive to say that people have to keep pumping money, irrespective of whether they made money or not. But if you are to do some kind of zero budgeting and look from here onwards, I would say that we are in a reasonably good wicket, accepting that we need to probably wait it out a little long.
Well, Anand, appreciate your time. Thank you for joining us. Stay safe, and thank you for your valuable thoughts. All right.